Welcome to Your Financial Advocate with Greg DuPont from DuPont Wealth Solutions. As a practicing advisor and attorney, Greg teaches pre-retirees how to reduce debt and taxes and save with less risk so they have more spendable income and plan their way to a better life. Join us for this journey where Greg draws on years of experience and guest experts to help listeners achieve more spendable income for retirement.
Hello and welcome to the Your Financial Advocate podcast. Today I'd like to share with you part one of two parts that were a recent webinar that I provided to my clients, kind of a State of the Union, mid-year report of the market. Today we're going to talk about how we got to where we are this year, what's happened in the market to get to this point, in the midway point. The second episode is going to talk about what we see looking forward. So hopefully you'll find this to be instructive, informative, and help you make some good decisions. If you want to see the slides that we reference in this presentation, please reach out to my team. Check us on our YouTube channel. You can see the real presentation. But some people prefer to listen to this in the car, and you shouldn't be watching TV when you're doing that. So take care, be well. Look forward to sharing this information with you. Bye. Hello and welcome to our presentation, Halftime Report 2024. Yeah, this year is halfway done. Where did the time go? Well, it went behind, it's gone, right? So let's look forward. Where are we going to head? Now, as we roll into tonight, I want to just take a moment and share with you the important things like disclosures. Yes, we're going to talk about some market information here. We're going to talk about the way it might apply in general to your world, but understand, this is not a one-on-one conversation. Most of you know who I am. We've talked before, and you know the drill. If you want something that's most specific to your situation, and by all means, if you're clients, give me a call at the end of this. But if you're just someone else out there familiar with us and the information we're giving, please, if you want more, please give us a holler. So I'd like to welcome you. Those of you that have been with us before, those that you have not been with us before, just a moment to introduce who I am. Greg DuPont. I am the founder of Advocate Wealth Solutions and the Wealth Solutions Network. And to combine, what we're trying to do is protect people like you from unnecessary risk and loss. And one of the ways that we're doing that is through providing information and guidance. And so now we're going to talk about information guidance as it pertains to 2004. And we're going to review the first half of the year. How did we get to where we are? We're going to take a look at what is the future. Yeah, the crystal ball is not working, but we're going to give it a try anyways. We're going to show you and we're going to talk to you about historical trends. What are reasonable expectations for the future? Now, if you've been within sound of my voice for the last, call it 18 months, you know that I have some troubled expectations about what is on the horizon, but so far it's not manifesting. And we got to get while the getting's good. And so the next thing after we talk about what's happened second half of the year, again, where are we now? Where are we in this global cycle that we're dealing with? What's it look like? What are the ramifications of it to you and to your family? And what's ahead for the second half of 2024 as we deal with the election season? Yeah, that's a fun thing to talk about, isn't it? So let's get started with context as to the first half of the year. What happened in the U.S. markets so far this year? Well, first of all, I'm going to talk in terms the S&P 500 because that's what the market media does. But you have to understand, and I always want people to reflect, that the S&P 500 is nothing but a reflection of what people believe is a representation of the U.S. stock market overall. And as we're going to dive into our conversation today, you'll understand why that really is not representative of what's going on perhaps in your portfolio, unless you're using an S&P 500 fund, which many of you have defaulted into. But it's not reality, folks. It's a little bit skewed from what's going on in terms of the health of the economy and the health of the market. So what happened in 2024 so far? Well, the S&P 500 it's gone up. But let's understand how it has been affected by what's going on in the economic situation. You see, in April 15, well, it dropped. Well, that's because we started getting some, shall we say, disconcerting information about where inflation was going and starting to pull back the hopium of the drop of interest rates. Well, guess what? Now the hopium is back in play because people are starting to think, hey, an interest rate or reduction is back on the table. And market fundamentally is driven by emotion, at least when it comes to most investors. Now, there are some institutional investors that have algorithms and things like that try to take the emotion out. But there are enough of us out here that trade based upon emotion that affects the market. And how do we figure this stuff out? There are these people out here that call themselves experts. I don't call myself an expert. I try to figure out the trends. The experts of the market, so to speak, if we look at their forecasts coming into 2024, well, they were just about as spot on as they were in 2023, which means not at all. Coming into 2024, Morgan Stanley, JP Morgan, RBC, BOA, Deutsche Bank, Goldman Sachs, all these big names had a group average projection for the S&P 500 of 4,817. Well, on May 31, it closed at 5,277. Now, still have plenty of time for the market to give back that upside, and it may happen. We've seen some trends that way. We see the effect of market forces. So how are these going to affect us going forward? So at this point in time, we've been on a ride. We have been fueled still by excess capital out there. All the money that the Fed has printed is still sloshing around, and it was going into the market. And that's what drove things initially as we came out of COVID. The massive infusion of money into the system by the Fed. Now, we've now seen some cycling on that. We've seen a lot of money that's now moving to sidelines. And why is that? Well, as we're going to see later, and as you may have experienced and seen, it's not too unattractive to put money into cash right now, to money market accounts, paying 4%. So a lot of money has moved off into a non-risk position. What's going to happen in the future? That's the great question that we're facing right now as we are in the summer of 24 and looking forward. What will happen with all the money on the sidelines when we start having less return on capital in the form of interest rate? So perspective here. When we look back in January 2022, one of our sources here that provides us these projections every year. And one of the interesting things is when we looked at January of 2022, when we look at 20 different economic indicators from monetary policy to the U.S. economic outlook to the yield curve, customer sentiment, et cetera, et cetera, et cetera. In January 2022, 17 of those 20 were all way positive. And 3 of them, political environment, geopolitical risk, the equity market valuation itself in a historical perspective, those were the only ones that were neutral, not negative particularly, just showing caution, warning signs of what the future looks like. And then we roll around a few years later, January 24, coming into this year, and we see at that point in time, most things were neutral. The international economic outlook, equity market valuation, geopolitical risk, those were downright negative just 6 few months ago. And as we moved into the summer, what we were seeing is more positive. We're seeing that at least where it pertains to the consumer sentiment, the labor market, housing and mortgages, consumer spending, corporate profits, credit availability, inflation, all those have started to trend positive now, while equity market valuation, geopolitical risk are further into the negative. And this is reflective of the mass of as we'll talk about in a moment, the economic minds of the world. Okay, we're going to show you some information here from the Fed, the 500 different economists. What are they thinking? All of these factors are coming from a pool of leading financial minds. Some would say perhaps a little groupthink is there. And I want you to take everything I say tonight with regards to a positive or negative view of what's going to happen in the economy and the market with a grain of salt, with your own perspective, because it does really depend upon where you are in your personal journey, as we'll talk about in a little while. So as we move on, right now we've got some serious negative factors in play at the equity market valuation, as we'll share in just a moment, and the geopolitical risk, most notably China, Russia, Ukraine, and, well, some people would say right here in River City. But those are factors that affect at this macro scale. And what we need to look at is, okay, at the market scale, what's going on here? What is really driving this S&P 500 that, again, is used as the proxy for your market investments? And understand that the value of a stock and the value of the market in general is thought of as a forward-looking indicator. Essentially, what they say is what the stock valuations now, what the market valuations now, is a reflection of what the groupthink that is in the market thinks that a company will be worth in 6 to 9 months, what the economy will be like in 6 to 9 months. And we see here in this slide that it typically does trend very closely. In a moment, we'll see that we're diverging from that significantly now. And there are some reasons for that potentially. When we look at the overall economy, where we are right now, part of the reason for some of those green indicators, those positive signs that we are going where we need to go from a market perspective, is in fact the manner in which the Fed has gained a level of control over inflation, which many people didn't think was going to be possible this quickly, this successfully. Now, there are many reasons to be a doubter and a skeptic on that. I know many of you out there are. I tend to agree with some of you on some of those thoughts. But the numbers are driving the decisions. And the numbers are what are driving the market. So we don't pay attention to those numbers at our own risk. So what we see is year over year, the inflation numbers have gone down. In the month over month, inflation numbers have gone down as well. Today, we had another downward cycle, so it's trending in the right direction. We're getting very close to the Fed's target rate that they feel is supportive of their mandate to promote full employment and growth. Now, we'll talk about a minute here. We got the big Fed meetings coming up real quickly here, and who knows what's going to happen from that. Could be a lot of excitement, could be a lot of disappointment. We don't know. We know where things are heading. Part of what's driving the Fed's decision is their interpretation of the strength of the labor market and their interpretation of whether or not it is an overheated labor market, which is now going to give cause for concern about a inflation like we had in the 70s, where it was wage-based inflation, where wages are pushing the inflation rate more than trailing it as it has been now. And they see from their numbers that we've got low unemployment, and we see we have a good number of current job openings for that unemployment. So they're seeing a very stable labor market right now, which is good for the prospects of them believing that they're on the right path. It's good for the prospect of them going ahead and reducing interest as opposed to increasing or maintaining even longer. And part of what is this really delicate dance of what is the economy, what is market growth, and what is the Fed's mandate on this comes from you, folks, your consumer sentiment. And this is one of the things that we showed in the earlier slide that is positive. by the numbers that they've used, by the studies that they have used, which is based upon a study out of the University of Michigan that samples about 500 households, and based upon this ongoing analysis of consumer sentiment, it's trending upward. We're feeling better about things. You may not be, your neighbor may not be, but they think it's happening. Who knows if it's reality, and who knows where it will change. But these are, again, the factors that the Fed is paying attention to, and this is going to be what's driving the market's reaction going forward. So from a global level right now, from the structure of our economy, we have the reduction of the growth of inflation, which is good. We have the good consumer sentiment. We have strong labor market, and these are all signs that will potentially lead the Fed to stop what they're doing, open up the floodgates a little bit, and allow some more money back in the system in terms of reducing interest rates. And so on top of that global picture from the political scene, as it were, what's happening right now in the market is this incorporation of the concept of artificial intelligence. And as I said, looking forward, as the markets tend to do, starting to project what will be the impact on various companies from AI, their incorporation of AI, and how soon will that be adopted? So now, as this chart is showing us how many times artificial intelligence has been mentioned on the quarterly earnings calls for publicly traded companies, and you can see that it's moved up tremendously since last year, as it's now becoming adopted. It's now becoming to the point where, major companies are going to have, the chief AI officer and those type of things to try to develop the strategies for implementing AI in the businesses. Now, again, if you've listened to me for the last 18 months, you know where I feel about a major transitional change in the economy, and part of it being driven by the effect and the impact of AI upon white collar and intellectual horsepower, us, the displacement that will happen with that. But from a market earning and a valuation of the businesses, stock value perspective, we're seeing now that is starting to be reflected now more broadly. I'm going to talk to you in a little while about the impact of the Magnificent Seven and what it's been like and how things are changing a little bit on that as this all evolves. So where are we now? As we head into the second half of the year, we know it's going to get crazy out there, right? Politically, it's going to get nuts. We've already seen some of that, and there's no reason to expect it to get any better. And what I want to dispel right now is that many people believe that there is a correlation between their party and the performance of the market. And that really does not hold true. We're talking about those bigger factors that we spoke of just a moment ago that are what drives it. And we think about historically what has happened with elections and markets. If we look back to 1944, since then, there have been 20 presidential elections. In 16 of those, the S&P 500 experienced a positive return for the year. And many of them had a median return of about 10.7%. Of the 4 elections that saw a negative return, well, 2 of them did occur in the recent past, in 2000, 2008. But on both those occasions, we had problems bigger than what was going on with the parties. And then if you think that, okay, one party is more prone to having better growth in the subsequent years than the other, that doesn't stand the test of time either. It basically cuts both ways. These are just partisan thoughts. If we look historically, there has been increased volatility from now through the election. So if you're concerned about volatility, if you can't stand that, then you need to take some action, because the chances are it will get rocky between now and then. Historically, if we look at that, the S&P 500 between the period of summer to the end of the election is about 5% lower than it is throughout the rest of the year. Okay, so there is some effect. Whether it's long-term effect, that remains to be seen. And for this year in particular, as we are dealing with the Fed, there is talk, concern, and we'll see whether or not this is true in the upcoming weeks, whether or not there's going to be appearance of gaming the system for better return so that there's a better economy. We'll see. But here's what I want you to understand. Outside of this macro problem and these gyrations, there is a fundamental market problem that is brewing, or it is a fundamental change in the market. Only time will tell. And here's what I mean by that. These are numbers that we look at on a regular basis to help guide our clients, to try to understand what's going on in the market right now. We look at, what's going on with bank CD yields. And right now we can pull up bankrate.com, get a 2-year CD for just under 5%. 3-year, about 4.5%, 5-year, about 4%. Now, those numbers have been coming down steadily throughout the course of the year. Okay, it's a trend that we need to be aware of. If we look at the S&P 500 average dividend now at 1.27, again, that has been a trend that's been dropping throughout the year. And the one that I really want to point out to you is this Shiller PE ratio. Okay, if you've listened to me before, you're probably getting tired of me pointing this out to you, but maybe if you've made note about this, you will note that it has been increasing this year. It's now at 36.37. Historically, the median of the Shiller PE ratio, which is a measure of the value of the companies versus what their earnings are. Remember, I told you that the market's supposed to be looking at what the earnings are down the road and using that as approximation for what the value is. So now it's 36.37. The median is 15 and change. The highest it's ever been has been 44.19. So, we could be moving into a new era where these type of multiples are the norm. I don't know. But we also look at things like market capitalization versus GDP, which is a number that Warren Buffett's famous for paying attention to as one of his lodestones. At 197, again, this number has been going up all year. And this is a measure of the value of the market versus the gross domestic product of the country. And historically, anything above 135 is overvalued. So all of these signs continue to tell us that it's time to proceed with caution. Are we at a point where we have hit the high point, where people should sell high? Or do we have a lot of headroom to go? No crystal ball here, folks. Not even going to hazard a guess. So separate out the noise, or do as I do. Stay away from the news. Enjoy your life a little bit more. So until next time, I hope you found your time spent with us here today to give you some important perspective on where we are and where we're heading. And as always, if you are a client of ours, please pick up the phone if you got any questions. If you're just a friend of ours that's receiving our information and needs a couple questions answered, please feel free to reach out to us. Take care. Be well. Goodbye.
Thank you for listening to Your Financial Advocate. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of DuPont Wealth Solutions. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.